Hello and welcome. Today, we're tackling a tax trap that catches thousands of people by surprise every single year, stamp duty land tax. And we're not talking about buying a house, we're talking about what happens when you simply transfer one.
Get this. You do something wonderful, like adding your partner to the deeds of your home. It's a huge step, right? But what if I told you that simple, loving act could trigger a surprise tax bill for thousands of pounds? No joke. That's the hidden sting in the tail we're going to pull apart today.
Now, to make sure we get this absolutely right, we've got the latest insights from the experts at My Tax Accountant. All their information is fresh as of November 2025, and it's exactly what you need to know for the 2026 tax year. So, let's dive right in.
All right, first things first. Let's get on the same page. What even is stamp duty land tax?
Okay, so in a nutshell, SDLT is the government's tax whenever property or land changes hands in England and Northern Ireland. But here's the kicker. It's not just for when you buy a place. It can hit you when you just transfer ownership too. And you gotta be quick about it. The deadline is super tight. Just 14 days after it's all official to get it filed and paid.
Okay, let's talk numbers. This is where it gets real. The goalposts for SDLT moved in 2025, and those new rules are what we're dealing with for 2026. Honestly, this is where a lot of people slip up, just by looking at old information.
So, what was the big change? Well, on April 1st, 2025, that temporary tax break we had, it ended. The amount you could spend without paying any tax at all, the nil rate threshold, got slashed in half. It went from £250,000 all the way back down to £125,000. And what that really means is, boom, suddenly a whole lot more property deals are now on the hook for tax.
Right, so check this out. These are the rates for 2026. Assuming we're talking about your main home. It works a bit like income tax. In slices, you pay 0% on the first £125,000. Then, for the bit between that and £250,000, you pay 2%. After that, it jumps to 5%, and so on up the ladder. You're only taxed on the portion of the price in each band.
Let's put some real numbers on this. Say you're a freelancer in London, and you buy a flat for £400,000. How does the tax break down? Well, you pay nothing on that first £125,000. Then, you pay 2% on the next slice, which is another £125,000. That's £2,500. And finally, you pay 5% on the last bit, the final £150,000, which adds £7,500. So you add those up, and the total SDLT bill comes to £10,000. You can see how fast that escalates, right?
Okay, so that's the basics of buying. But now, let's get to the real heart of the matter. This is what we're here for. What happens when you're not buying? You're transferring a property you already own. And seriously, stay with me here, because this next part is where it gets really surprising.
So picture this, a scene that happens all the time. You own your home, you get married, and you want to add your spouse to the deeds. Make it official, you know? No money's actually changing hands, so it's tax-free, right? Well, maybe not.
And this, right here, is probably the most important thing you'll hear today. The tax isn't based on money paid. It's based on something HMRC calls chargeable consideration. And here is the giant trap everyone falls into. Consideration is not just cash. If the person you're adding to the deeds takes on a share of the mortgage, that debt, that's the consideration.
Let's walk through an example to make it crystal clear. Let's say we have a house worth £700,000, but there's still a big mortgage on it, say £600,000. The owner transfers half of it to their partner. That also means the partner is now on the hook for half the mortgage. That's £300,000 of debt they've just taken on. And guess what? As far as the taxman is concerned, that £300,000 is the price tag. That's your chargeable consideration.
So what's the tax on that £300,000 of mortgage debt? Let's do the math using those 2026 rates. You get the first £125,000 tax-free. Then you pay 2% on the next £125,000. That's £2,500. And then 5% on that last £50,000, which is another £2,500. Add it all up, and you've got a surprise £5,000 tax bill. Just for doing something you thought was a simple gesture of love. Ouch.
And this brings us to a huge pro tip, straight from the folks at My Tax Accountant. They say the biggest mistake they see is people thinking they're gifting part of a property. But if that gift comes with a chunk of mortgage attached, HMRC doesn't see it as a gift at all. It's a transaction. And that misunderstanding can be seriously expensive.
But wait, that's not all. And this is another area where people really get it wrong. The rules are totally different if a relationship ends. If you're married and getting a divorce and the house transfer is part of the official court order, then there's no SDLT to worry about. But, and this is a big but, if you're an unmarried couple splitting up, the normal rules apply. That legal piece of paper makes all the difference.
Okay, a quick but really important detour. Everything we've talked about so far is for stamp duty land tax, which is for England and Northern Ireland. But property tax is handled differently in Scotland and Wales. They have their own rules. Let's have a quick peek.
So in Scotland, you're looking at what's called Land and Buildings Transaction Tax, or LBT. In Wales, it's Land Transaction Tax, LTT. The general idea is the same, but the numbers, the rates, and the thresholds are different. For instance, in Wales, you don't pay any tax on the first £225,000, which is way more generous. The bottom line is, always check the rules for the country your property is in.
Right, let's get into some practical stuff you absolutely have to know to avoid getting hit with penalties.
Okay, so you've done the sums, and it turns out you do owe some SDLT. The next question is a big one. How much time have you got to pay it? Because trust me, this is one deadline you do not want to miss.
14 days. That's it. Just 2 weeks from the date the transfer goes through to get your return filed and the money paid to HMRC. It's a ridiculously fast turnaround, which means you have to be ready for it. Be late, and you're looking at penalties and interest payments.
Okay, time for some rapid-fire pro tips from the team at My Tax Accountant. You ready? 1. Even if you calculate that you owe 0 tax, you often still need to file a return. Yeah, really. 2. If you're transferring a property into a company, the tax is usually based on the property's market value, not what the company paid for it. And 3. Never forget about the big surcharges if this is a second home or an additional property. That's a whole other level of tax.
Wow. Okay, we have covered a ton of ground. And I think it's pretty clear that this isn't exactly straightforward, right? It's a really complex part of the tax system. And while you now have the key things to look out for, everyone's situation is a little bit different.
So it's really important we say this. Please remember that all this information is for general guidance. It's designed to make you aware of the issues. It is absolutely not a substitute for getting proper, professional advice that's tailored to you and your finances.
And let's end on this one thought. For nearly all of us, our home is the biggest, most valuable thing we will ever own. Getting the tax wrong on that isn't just a small error. It can be a massive, costly mistake. So the real question is, can you really afford to just hope for the best?
Look, before you make any moves, the smart play is to talk to an expert. You can get in touch with the team over at My Tax Accountant for professional one-on-one help with this and any other tax questions you've got. Their number is +0208 570 8531. If you want to read more on this, we've linked their brilliant article on the topic. And of course, make sure you subscribe for more guides just like this one. Thanks so much for joining me.